Welcome, everyone. This is Mike Wise with the Boston Blockchain Association. Welcome to episode number 10 of the BBA virtual meetup. We're so glad you're here. Thanks for joining. We're really excited about the panel tonight. Let me just share my screen. So we've got a lot going on. Sorry. We've got a great DeFi panel tonight with John Sarson, Blake Richmond, Paul Dowding, and Stephen Leahy. The Boston Blockchain Association is a community of innovators, collaborators, and entrepreneurs excited about the promise of blockchain technology. And we're building Boston into a global hub of blockchain. So hashtag Boston Blockchain if you're sharing anything on Twitter or social media. The mission is a threefold mission: to establish Greater Boston, Massachusetts as an international hub for blockchain innovation, to support, educate, promote, and advance blockchain technology, and to connect entrepreneurs with useful resources. It's a member-driven organization, so we would love it if you would join us at the bostonblockchainassociation.com. I want to shout out to our corporate members, Algorand, Bloomy, Pure Stake, the Fed, Boston Fed, Media Shower, Consensus, Fabric, Northern Bank, and Clove Crypto. I'd like to introduce Stephen Leahy, fellow board member. He's going to walk us through our panel. Stephen?
Hey, thanks, Mike. Thank you so much. My name's Steve Leahy. As Mike mentioned, I'm a board member of the Boston Blockchain Association and am very pleased to be moderating what's going to be a lively and interesting panel for us this evening. The title of the panel is DeFi: What, How, and Why? And thankfully, to help us navigate our way through DeFi, we've got three experts on here. First up, you can see is one of our guests, John Sarson, who runs the fund services company under his own name, Sarson Funds. John, can you give us a little bit about your background?
He's on mute.
Oh, thank you. Mute button. Mike, Steve, thank you. Yeah, so I have a background in traditional Wall Street. I worked for Lord Abbett and Dreyfus and Guggenheim, selling their packaged investment products through financial advisor networks on the East Coast. I'm from Massachusetts. I'm from the South Shore, actually, Hanover. We have an office in Hingham where we do marketing and distribution. And then we have our investment management office for my firm in Indianapolis, where I have relocated to with my wife and 3 kids. And we got into cryptocurrency 3 years ago. We got into DeFi about 1 year ago. And I like what I see in DeFi, and I am looking forward to talking about it.
Excellent. Thank you, John. Next guest we've got is joining us tonight is going to be Blake Richmond. Blake's got a number of roles in the digital asset industry as a VP of Finance for Vitalo. He's a Chief Investment Officer over at NovaBlock and also runs a DeFi yield farming portfolio. Blake, can you give us a little bit more about your background and how you got here tonight?
Yes, thank you for having me. I started my career in venture debt and venture capital, working for Hercules Technology Growth Capital. I later left that to start my own fund, NovaBlock Capital, with 2 partners, focusing on blockchain-based capital markets infrastructure. I was hired by one of our portfolio companies, Vitalo, to help digitize every asset. And then recently started with a DeFi yield farming portfolio as well.
Excellent, thanks so much. And our third panelist is Paul Dowding. Paul is co-founder and head of design at L4S Corporation. L4S offers enterprise clients a dramatically different approach to distributed ledger tools and technologies. And Paul himself is a veteran of the capital markets, having worked for a number of the big name firms such as Bank of New York Mellon, Goldman Sachs, and Bank of America in capital markets and prime brokerage. Paul's got a slightly different take on the world of DeFi. There's a lot of promise, but we probably have a long ways to go. Paul, can you give us just another moment or so about your background?
Sure. My career has progressed from, I was originally an engineer, went to banking operations and progressed through service and product management, and innovation, and I've supported custodians, fund managers, brokers, and depositories and exchanges in different roles. So I've seen front to back of the industry, looking into the potential of what were distributed ledgers and blockchain 5 years ago. I saw the potential, but also saw some of the limitations, and that's what led to the design approach for what I'm doing with L4S. And I love the creativity and innovation within DeFi. I believe, though, that there's limitations and certainly issues to be dealt with before it really can take off in any grand scale.
Excellent. Thank you, gentlemen, for the introductions. And so again, my name's Steve Leahy. I am moderating this panel. And I think you'll find that not only are our panelists experts in the subject matter at hand, but what we're striving for here is really a discussion about DeFi. So I, as moderator, will try my darndest to guide the conversation, but that's really what it is, a conversation and discussion. And so decentralized finance. Essentially, decentralized finance, or DeFi, is the notion of removing traditional intermediaries from the banking and finance activities. I think that Bitcoin was probably the first representation of something that was truly a decentralized finance tool. Bitcoin itself considered kind of the king of crypto at this point in time, but it really showed a way to decentralize the ability to store value, transfer value. Next up, in about 2017, we started seeing these ICOs, which in my mind were kind of the next step in decentralized finance. ICOs raising capital for projects, avoiding many of the traditional banks, allowing for most anyone to join into these. Some of the efforts were questionable, maybe a lot were questionable, but the concept of trying to find a way to finance projects and companies while going outside traditional financial services and intermediaries was certainly interesting at a high level. And currently, we're at the world of DeFi, or true decentralized finance. At the moment, we see a heck of a lot of the DeFi world is focused on lending, but more and more financial services will be targeted by the innovators in the space of DeFi. And that's part of what we're going to be discussing here tonight. And so first, just like the name of the panel says, we're going to talk about what DeFi is. We're going to talk about how DeFi is created and how one gets involved in DeFi. And finally, we're going to talk about why are we doing DeFi? What needs to be found? Are there any lessons learned? Certainly, we'll touch on regulation in probably a couple of these three generalized areas. And finally, at the end of the discussion this evening, I'm going to ask the panelists for what they think about the future of DeFi and what that will look like, what lessons we've learned from DeFi so far, and then we'll be taking audience questions as well. And as those of you who are regulars here to the BBA's panels, at 7:30, we do have a couple of breakout rooms where the panelists here will be speaking with and part of the discussion about members who choose to join in. So, is everyone ready? Here we go. So let's start off, gentlemen, with what is DeFi? And to me, DeFi, it's this umbrella term for blockchain-based financial applications that don't rely on central intermediaries for permission or execution. Can I ask each of you to kind of give me a little bit of idea of what's your definition when you think about DeFi? What is DeFi to you now, and where's it heading? And maybe an example of some of the projects that really got you interested in DeFi. John, you want to start us out?
Yes, I would be delighted to. Thank you. For me, I'm a financial services background person. So DeFi to me looks like financial services on chain. And by everyone on the call probably knows what on chain means, but financial services, the full gamut, can be moved on chain given the right software. And DeFi is doing that, and in the process, I believe reducing fees and taking overhead out of the equation. Financial services as a segment of our economy is all of a sudden 7% of our economy. In the 1960s, it was 3.5%. Jeremy Grantham pointed this out. So he speculates: did people's need to package investments and save for retirement become twice as acute, or are we just charging twice as much for the same service? I think everyone knows the answer to that. So DeFi is a solution for financial services done at the peer-to-peer level.
Excellent. Thanks. Blake or Paul, you guys want to hop in on that and give a kind of your take on what DeFi is and maybe an example of what got you interested in the industry?
Paul, you go right ahead, please.
Well, DeFi as it stands at the moment is definitely, as John says, a peer-to-peer, a decentralized mechanism to transact with each other, which is very interesting because it gets rid of central intermediaries, offers some less friction and actually lower costs in terms of transactional requirements. And actually, it's the answer to what's a lot of the problems with the centralized finance, because the centralized institutional financial is encumbered with 1980s code and huge infrastructure and markets. Although we can trade in real time, everything's settling next day or 2 days later. And it's taken the industry 20 years to get from T+5 to T+2. So there's a lot of reason to sort of look at the whole industry as a whole. The reason I got interested in DeFi was I'm very interested in distributed ledgers and the blockchain technology and decentralizing finance, but the institutional regulated markets as they exist today. So I am trying to short circuit the main industry, but I'm doing it from a different route rather than going purely in the crypto space. And I think the area there has its own issues with performance and scale and just regulatory compliances and other issues, but we can talk about that in the discussion.
I think regulation is going to weave its way into many parts of the discussion here this evening. Hey, Blake, can you just give us an update on to what is DeFi to you?
Yeah, I mean, in my view, it's just how you deliver financial services on a decentralized and permission basis. And that could be anything from lending and credit availability to trading to insurance and risk management. Every function of modern finance can in some way be represented digitally, and whether it has to date or not, it depends on the role and the intermediary being disintermediated. But I think John and Paul gave perfectly good explanation here. We're just delivering financial services permissionlessly and on a decentralized basis.
Right, without those intermediaries in the middle that are often described as rent-seeking intermediaries. That being said, part of the intermediaries allow for regulation, and I do think that within financial services, at least here in the kind of modernized banking era, that regulation is necessary. Is there a way to do? I guess my question is there a way to do DeFi without blockchain per se? Like, could you just have peer-to-peer trading of stocks and settlement without blockchain technology? And Paul, I'm going to toss this to you. Or is blockchain that core element to allow for the disintermediation we're talking about?
I don't believe, well, blockchain, the concepts behind it, and I've been fortunate enough to actually meet Scott Stornetto, who's one of the co-inventors, the 1991 paper, the concept of a blockchain, of that hash-linked data, is really an append only. It's meaning once you've updated it and you're hash-linked, you can't go back and change it. Or if you do, it's evident. And the way that it remains very more secure is if it's distributed and shared amongst many parties. And that's the idea of a distributed network. So the problem without a central clearing counterparty, you have to have some way of trusting each other. Now, the old correspondent banking networks used to be able to do that with having accounts with each other, and our model follows a similar one to that. But the idea of the blockchain is that if you've distributed ledger, then everybody knows what, at least the valid in terms of an asset that's real and can be transferred. But so I do believe distributed ledgers are going to allow the decentralization. I'd like to clarify something. I believe a lot of the central clearing houses and those central clearing places will be disintermediated. But I think with fiduciary responsibility or advisory responsibility, or even going through a fund structure, you're always going to come through some kind of intermediary for either advice or guidance. Very few of us set up our own internet connections. We go through an internet hosting service. So I believe that'll be the model, going forward. And I see something similar in DeFi already with, whether you've got a wallet or you're going through a platform, you are going to go through an intermediary. So don't think all intermediaries are bad. It's just really the key is the decentralization and the efficiency.
And some of those some of those entities through which one must pass can be actually protocols rather than necessarily corporations. Like, you can give us a little something about protocols versus corporations when it comes to being how one interacts with one's peers, like Uniswap?
Yeah, I think that's really the answer to the question. Is you're not removing the intermediary, you're using a software-based intermediary, and when that code that is open source and you can review it, you can check it, you have a public and pseudonymous source of truth, the public ledger. You're not removing the intermediary, you're just changing it to one that you don't have to trust, you can go and verify. So I mean, to answer your earlier question, do we still need intermediaries? One, what is an intermediary anyways? Two, if you don't want to have to trust a Seed & Co. or a DTCC and you know, some of the traditional finance clearinghouses and brokerages, prime brokers, then substituting software with open source code is probably a better alternative.
And John, you're nodding along there. Why is open source code, why is that more trustworthy than Goldman Sachs stamp of approval?
It's more democratic, and it's more of a level playing field. So therefore, it is idealistically superior, in my opinion. You know, not everyone has a credit score with Goldman Sachs. Not everyone has an account with Goldman Sachs, but everyone can open an Ethereum wallet. And so for that reason, blockchain technology, ability to intermediate that trusted third party is like a gathering or joining mechanism that brings to decentralized finance a larger number of participants than could have ever been brought to centralized finance. And this is a very positive thing, and it does it without the worry of corruption, because there's transparency on both ends of a transaction. We love when we can trade or do a investment that we do on chain at my firm, because there's no counterparty risk. And we like having no counterparty risk. Even the best counterparties, AIG was a big insurance company, and you know, a bulletproof counterparty, and we all saw how that almost ended in complete disaster.
Yeah, that's a good point. I was listening to a podcast recently by someone whose name I forget, but one of the many smart quotes they gave is that, in a way, doing DeFi and using smart contracts means that you're putting your trust more in the math and the science rather than in the name, brand, reputation, and regulation of any traditional bank. Let me turn this to Paul. Do you want to add something?
Well, I was just going to say the challenge with what is regarded as a protocol or a smart contract is that they are customized, you know, vulnerable sets of code. However many people have agreed to them, and we've seen multiple instances of where these have been abused or hacked, including the granddaddy of them all, Ethereum. So there's, you know, with the DAO hack. So you've got to understand that there's a limitation to sort of trusting in the code. And the other point is, beyond an intermediary, once you get into a fiduciary role, you've got to consider, you know, where are you putting your responsibilities in, and what's your level of recourse. And then last point I'd make is, it's not a question of that DeFi or blockchain or distributed ledgers are working. They are. The question is, to what extent are they working? Ethereum has severe capacity constraints. It's getting ever bigger as far as its memory, and it really can't scale. And this has been the issue of the industry. So the part of the issue is, you do get to a faster settlement time, which does remove some of the risk, but you don't get to an immediate near real-time settlement. And that's what the industry needs to hit. And there's no way with the current distributed ledger or blockchain designs that can be met. So there's a huge performance and scalability issue that's sort of looming in the background beyond the control and fiduciary responsibilities.
Can I just respond there? Because, Paul, so, you know, one thing that I've thought about is what happens when you have this immediacy and irreversibility of settlement and someone makes a mistake. There were headlines a few weeks ago, Citibank sent $700 million erroneously to a hedge fund to settle a mark-to-market.
Well, there's two sides to that. One, there isn't immediacy right now. There's all latency, and it's arbitrary in any of the blockchain solutions. That's why we're aiming for a near real-time settlement. But the idea of the near real-time settlement is you don't have the concept of a cancel and correct, but you've almost got an immediate view of why it should be wrong. So you can actually stop the issue at inception. It doesn't get recorded. So those are just some of the challenges. But the real problem on the institutional side is if you don't have real-time settlement, you have to pre-fund your trades, and if you can't pre-fund them with arbitrary settlement. So everyone's just going to do end-of-day settlement. End-of-day settlement means overnight financing, and you lose all the efficiencies. So you need to get to near real-time settlement, and there's nothing about consensus or mining that's near real-time. It's an arbitrary time frame thereafter that you can actually truly confirm. You might not have counterparty risk in a day, but you've got it for that hour or time frame, whatever it takes to settle the blockchain.
Interesting. Hey, Blake, can I turn over to you, because I know you are active in the yield farming industry. You're running a portfolio. I would assume, and there's been some troubles, so a lot of pros and a lot of cons about the yield farming portfolios out there in the world. But when Paul was mentioning the idea of like settlement risk and a little bit of a delay, even if it's only on the Ethereum network, to someone who's had traditional finance background, T+2 settlement's pretty darn good. So even if you're waiting on the Ethereum network a couple of confirmations, that's pretty fast and nimble. Can you talk about the idea of your trade, again, keeping with the theory that we're still just talking about what DeFi is, can you tell us a little bit about the trading aspect and the settlement aspect of these smart contracts that you're entering into? And maybe even describe a little bit about what a smart contract is as we start heading towards the how section of this panel.
Yeah, just want to remark on Paul's earlier response. T+2, it's great, it's beautiful. 15 seconds to a couple minutes, much better, obviously. But a really, really interesting piece that I think you started down the road, but you didn't quite hit on, is capital reserves. If you can settle these transactions near instantly or in a couple minutes rather than 2 days, that capital turnover that you'd otherwise have to sit on for some of these larger institutions, that limits everything from lending to accepting deposits to clearing additional trades, hedging risk on their current book. So that's a really, really interesting piece that you just scrape the surface of.
I completely agree that's actually why we're heading to near real-time settlement. The problem is that you open up the Aladdin's cave of $300 billion of pre-funding. But
exactly.
That's why actually...
You got to push these things.
But that's the really interesting thing about DeFi is that you've now got to have intraday financing. So rather than borrowing a security overnight to repo, you'll be borrowing it for 5 minutes while someone's pending a settlement. So.
And what a better time to make that shift than while we're going from LIBOR to SOFR and starting to think about these minimum increment lending intervals. Sure.
And I love the potential, believe me, because think about it. Now any asset can be financed, and then you get price transparency, and liquidity. The liquidity in the bond market is not decided by buys and sells; it's defined by financing. So
yeah, and by the Fed at this point. Yeah, but
well, that's the baseline. That's the baseline. Oh God.
Anyways, back to the question at hand: is the trading experience good? Let's start with what a smart contract is. It's a transaction that's predefined and will execute if a certain parameter or set of parameters are true. That is, if these are true, then this transaction happens. That model can be expanded to custodying until certain liquidity is aggregated and able to be traded against. The smart contract model has taken on so many different permutations. It's impossible to describe and be a lot of time here, or weeks for that matter. But from a trading experience, does this rival, the CLOB or centralized exchange model? No, it doesn't. It's an empirically worse user experience. The liquidity in some cases can be deeper, and that's by design of, rather than having an order book, just having a big pool of capital to trade against. in certain periods, yes, that big pool will be more liquid than a centralized order book, and that's typically measured by the plus minus 2% liquidity from spot. But it's slow, it's clunky, it's not. I mean, like the 30 or 18 or however many order types that you can have, good until or one cancels the other. That's not available. So it's something that's beautiful in that you can set up any pairing that you want. You can provide liquidity to these pools and in turn receive a certain or a pro rata percentage of the transaction fees against that pool. But it's not necessarily the best trading experience. Coming from a fund that was actively managed and actively traded, that experience was so much more seamless and so much easier. But the difference is that this is all happening on chain and it's all happening permissionlessly. I don't need to have an EIN or a bank account or as an individual, my own KYC, AML information, and possibly accreditation to be able to access this. So it's, I know there's a lot there. There's like the experience piece, which is good and getting better, but not great. But then also the permissionless delivery of that experience, which I think is great, unless you're skirting the KYC, AML, money laundering, and terrorism financing laws, of course.
So I'm gonna pick up on one of the things you said as we transition into the kind of how is DeFi created and used. And one of the questions I think a lot of people have is, so what exactly is a lending smart contract? Why, what is happening there when you see all these lending smart contracts on Uniswap? Between yourself and John, can you guys describe what a lending contract is and why these annual percentageized returns are like so skyrocketing high for short periods of time?
Sure, I'll handle that in two parts. First, we like to do on-chain lending, and I think of it kind of like a giant string that's attached to my collateral. So it goes out in the world, and the covenants are babysat by the software. And something happens that triggers me pulling my collateral back. I pull in the string, and it comes back to me. I never really let go of it. It's all connected on chain. Versus traditional finance, where if there was a covenant violation, I would have to hope that it was noticed. Then we would have to talk to a third party, that was the bank, and let them know we want to foreclose on that asset, and talk about a different experience than just pulling the string back. It just comes back to like the custodian keys that just pop back. Mm-hmm. The covenant's been violated, asset comes back. I like that. I like that kind of.
But to be clear, it's not your choice to pull back. At the moment, your choice has been decided already when you bought into that smart contract and said, if this happens, then my money comes back, correct? Yeah. It's not your choice to pull it back. It's whether something's been triggered that.
That's right. Like and it can vary widely. The sky is the limit for what those parameters could be. And this is why oracles like Chainlink are becoming so useful, because they go and check on the status of these different covenants or parameters for these smart contracts. Now, when you're seeing these giant yields in these DeFi pools, and I'll share a screen and if you want, or let's see if I can find a pool here. It looks good.
By the way, you mentioned the sky is the limit a moment ago, and I thought you were already talking about the APRs here.
So there's a couple different buckets here. The insane APRs. It's when we're talking about lending markets, that is on a very interim basis, usually catalyzed by anticipated or incipient price movement, where one or several large parties want to borrow a token in order to manufacture a short position. But that's going to get you up to double digits. You'll see some things hit like 60% APY as a lender, which is insanity, of course. But that's not like the 4-digit APYs. The larger, more insane APYs and returns, that is not necessarily lending, but liquidity provision. So you have an amount of liquidity, you stake that liquidity in a smart contract. That smart contract is part of a new protocol or a new project that is trying to distribute a token rapidly and widely. So to their liquidity providers, they will emit the supply over a abbreviated period, and whether that's a couple of weeks or 4 years or however long, that market price times that emission rate is what's generating these outstanding.
Divided by the size of the pool. And the pools get larger when they have large APYs and they look like stable assets. So like this is just the yield farming section of CoinMarketCap's page. You can see some of these have quite high APYs, 2% daily. And that's because people don't want to be stuck along the asset that's inside the pool. So the pool's very small, but people want to trade the asset, so there's a lot of trading volume. And it has a high fee, I'm assuming too. We can't tell what the fee is without clicking through. But like combination of pool size, pool like velocity, and where the fee is set determines how much you're going to make on an APY. The widely understood reality is that the APYs won't last for very long, but they last for a little while. And as Blake was mentioning, the incentive tokens associated with coming and trying out a new pool, this is the newest way in crypto to get rid of the crap coins that people have issued, and they throw them in as an incentive token, and all of a sudden people have these things and they don't really know what they are, but they got them for free. So that's that's probably near where their value is, almost zero. But they can make it look like there's a really high APY for as long as that incentive program is in place.
So
and we're talking about.
Paul's chomping at the gums here. Go ahead, Paul.
Well, John just said it. So I want to be clear. This is not a Ponzi scheme, but it has a decreasing return sort of pattern. So the early, joiners of these pools, or they leverage up these assets, that's where they get a high yield. But over time, it will diminish in terms of its long-term returns. Secondly, a lot of these liquidity pools then offer comp tokens that then have their own inflationary, pricing as well. So there's actually people sort of losing money on the interest-bearing part, but making it on the rise in the comp token. So, you've got to understand, in the end of the day, a financing market is like any market, which is buy low, sell high. So if someone's paying you 6% interest, they must be earning greater than 6% interest, otherwise. And so there's this spread to the market, which people have to manage. And even, I was involved in prime brokerage where you're financing hedge funds. And, if you would make 50 basis points, you'd lucky if you made 70 basis points on a good deal. And the index arb, you're down to 10 basis point spread. But it's basically, that's the difference between your borrow cost and your lending cost. So a lot of these lending markets at the moment are a little bit, representative of their newness and some of the hype. They also rely on the fact that the underlying assets at the moment are tending to go up, or their volatility, if it's a stable coin, isn't so much. But going back to John's point about the coded string pulling, yes, it's a tougher experience to liquidate a collateralized loan if you've got assets, or even a prime broker working with collateralized loans to hedge funds. But the thing is, at least you're in control and you can manage the situation, you can assess it. In this case, if there is a volatile downturn, all the strings get pulled, and suddenly you're selling into a collapsing market and all the strings are more getting pulled. And what is going to end up happening is people are going to want to be the first string to be pulled. So the market will over time with volatility will become more and more conservative, and that'll drain some of the liquidity and returns.
Hey, Blake, I got a question for you. So you're involved in this on a day-to-day basis. Are these yields, are these prices and positions, are they whipping up and down intraday such that you can take a 5-minute break from your screens, or do these things happen in slower time? Are you like are you more trading these, or is it more like portfolio management where you have a longer-term time frame?
Yeah, it depends on the strategy. We started talking about lending and then got into a mix of lending and distribution APYs, and I do both. I provide liquidity in anticipation of that distribution APY. I provide or lend liquidity as a borrow low, lend high type of strategy. The specific markets that I use, across cream finance, compound, maker, and Aave. I'd say cream finance and Aave are probably the more volatile in terms of rate, and that's just because they are either the most liquid markets or they have added the newer markets that other protocols haven't. So when there's movement on some of those, then there's going to be a lot of people borrowing that token, selling it short, and buying it back. So those rates are changing. But something like Maker, which is not necessarily a lending and borrowing market, but more of a decentralized central bank model where they're creating credit availability through money creation via the issuance of their stablecoin DAI. That is a lot more stable from a rate perspective. And if we want to get deep into the weeds, there's also projects that are doing derivatives such as like rate swaps, and these ways that you can hedge these the volatility of your underlying interest rate.
Tell you that both in the why section coming up, and then in the breakout room where you're in, I'm sure there'll be people with questions for you there. I'm gonna ask John, if I may. John, can you succinctly and briefly describe what's a decentralized exchange versus a centralized exchange for those who don't quite understand it? I'm sure it could be a topic for hours, but can you give me like 2 minutes on the differences?
Sure. Binance has got a decentralized exchange, Binance Smart Chain, and Coinbase has got a partnership with 0x, which is a decentralized exchange. The difference.
What does exchange mean?
So the difference has to do with whether or not you have an account with the exchange or if it's a protocol you're using, essentially. When I have an account at Coinbase, they know who I am. I make deposits. They're my counterparty. I have counterparty risk. If they go bankrupt, then I may become an unsecured creditor to the bankruptcy proceedings. Versus like a decentralized exchange like Uniswap, where I come in, I do my transaction, and that's the only interaction I have with that third party, which is really not a third party, it's a protocol. I come in, I use it'd be like, I use the highway for a second. I use their roads, and then I go back to my Ethereum wallet or wherever else I reside. I do not leave my assets with them.
So not only are you not leaving your assets on someone else's book, whereby, again, in a regulated world, you would trust that their reputation and the government regulation means that you will get your money or value back when you want. Who you are or what you're doing. They're just a way for you to transact.
Exactly. You're exactly hitting the nail right in the head, but you're hitting the wrong side of the nail. Nobody wants to wait for the government or the regulators to tell them that they can have their money back. Fair. I think that's what the growth of the decentralized finance movement is all about. It's about Big Brother and a heavy hand and permissioned transactions, and whether or not that is the way that people think is the most efficient and fairest way to have financial transactions occur, and the safest way. Yes, there are smart contract vulnerabilities. Yes, there are codes that can be exploited, and that 100% is a part of the risk profile of the investment of using a decentralized platform or decentralized smart contract. Collaterals, investment or lending situation, manageable risks. Whether or not your government's going to take your money, and because you live in a country where the government's out of money, they need to pay the military again. Not a manageable risk. I don't have to worry about that. People around the world worry about that on a regular basis. If we were in Iran or Zimbabwe or Venezuela or Argentina or Panama, we would be very, very.
One of the Maker developers turned Yearn Finance developers. That was his big reason behind DAI. I believe he is Argentinian, and having his wealth in a decentralized stablecoin rather than or Argentinian peso, I believe. Or is it Bolivar, which had inflated 50% over the past 12 months, if not more by now. that was a massive wealth preservation. So it's not, we were very fortunate to not have to think about something like that being domiciled in the country sponsoring the global reserve currency for debt and energy. But in the rest of the world, that's a big consideration. How do you carry your wealth from today to tomorrow?
I do think that probably, for those of us who are fortunate enough to be sitting and or reside in kind of traditionally Western world and stable banking world, this stuff is interesting and cool. And if you've got like a libertarian slant, it's great. But there's certainly parts of the world, like you guys were just saying, where this is truly needed. You can't trust. I keep in my office a $20 trillion Zimbabwean bill. Worst case scenario, but it's there.
It'll come back.
Well, I think an important point to make here is that with the goal of decentralization, and I was said at the beginning, DeFi at the moment is purely the sort of crypto world, but the idea of decentralized finance is more that the individual can control their assets, and their assets can be their identity, their informations, their accreditations. So there's lots of, that's the real potential that everyone's is aiming for. But I'm just sort of cautioning the mechanisms that exist today and what's out there. And I love the experimentation. One of the issues, unfortunately, is they joke about the two certainties in life of death and taxes. But with these decentralized protocols, you are getting the execution, or you're getting the process, but you're not getting double entry tax lot accounting. So that's one of the areas where people are buying and selling these digital assets, and they're not considering things like wash sales or other tax requirements. So forgetting about the regulation of how you interact with these and everything else, and I'm a big believer on that being as light as possible. But I'm just saying the practicality of it is that you still have to account for these things. And one of the big holes in a lot of the current blockchains is they don't include double entry accounting, and they really haven't thought of tax lots, because most of them are dealing with what I would call balance changes as opposed to.
Let's get the other side of that, Paul, because we fight at work about this sometimes. My COO and I, she doesn't want us to do certain things because the administrators have a hard time auditing what we're doing, and to which I scratch my head and say it's right there on the Blockchain Explorer, so it's eminently auditable. And to let our behaviors be determined by like what we have to do when April 15th rolls around is very much letting the tail wag the dog, and I think it's the death knell to innovation. So I look for that.
Well, let me just throw that back to you in a question, which is, did you start your fund before or after the DAO hack?
After.
So if you'd have been trading before the DAO hack, there was a whole period of time where the Swiss foundation that runs Ethereum said, you know what, we're going to go in the Wayback Machine, unwind the whole quote-unquote immutable record, and then reconstitute it again. So your records would only be good in Ethereum Classic, not in the new Ethereum. So, and remember, Ethereum's just talking about going to Ethereum 2.0 with all its side chains and the beacon chain and everything else. I hope it works for you. But if it doesn't, you're in real trouble there. So I'm just saying this idea of, accounting and reconciliation is sometimes just glossed over, and there's a significant issue that's not necessarily been well addressed.
It's not been solved, I'll give you that. But triple entry accounting is what blockchain technology is, and it's better than double entry accounting, period.
Well, if 2 is good, 3 must be better. But remember, if you've got 3 entries, one of them has to be out of balance.
We have you nailed it in the beginning of this response, where you're saying that it's experimentation, and that's really the stage where we're at. We're experimenting. We're showing that this is possible, that we can hedge geopolitical uncertainty and credit risk via ease of moving into a global stablecoin or a US dollar denominated stablecoin. We're showing that the AMM and liquidity pool model works alongside the CLOB and central exchange model. We're showing that software multi-sig custody works, rather than engaging with a traditional AUM-based fee custodian. So, I mean, we're very much deep in the experimentation phase. And I'm sure the regulation and the tax law and KYC AML and terrorism financing and Bank Secrecy Act, that's all coming down the pipe, and it's not going to be fun when it gets here. But that's where we work with the ICO stuff. We wanted to show that capital formation is possible and that accelerated liquidity is possible. We did that. A lot of it was unregistered securities and the offerings thereof, and a lot of it did not map to US securities law or whatever jurisdictional securities law. But over the past 2 years, strides have been made against mapping the technology to the regulations. And I think you're going to see that again with these banking and lending models, with these exchange models. And that's what this space is all about, you know, finding a way around the current system or the rules, said differently, having the regulators notice, realizing that it is empirically or just incrementally better from either a cost of capital basis or user experience basis, and then applying the regulations to it and tamping down this fraud and the clearly negligent and fraudulent and nefarious activity, getting back to the software that works, and then building on that.
Yeah, no, I'm in agreement with you. What we're trying to do with our protocol and what we've got is a near real-time, scalable, high-capacity protocol that the transaction hosting services can use to settle amongst themselves. One of the things we can do is archive our periods, so you don't have this continuous active memory record, which then also allows us to do future dated payables and receivables. So we can actually do amortization, accruals, and everything. And the idea is, you know, the most of the, like, Bitcoin is great, but it's a fully paid for long asset, whereas most of the world is finance. You know, brokers notoriously buy and sell the securities that they're going to borrow or buy, or, you know, they're transacting. Banks don't actually have any money. They lend it out. So they're always continually financing a dynamic balance sheet. So unless you've got a mechanism to arrange this decentralized financing, but what we're I'm coming to the problem from the different direction, which is a protocol for the regulated entities so they can become hosting services and then do all these things in real time.
We don't see innovation come from regulation, you know, corner offices. It happens.
Well, I'm not in the corner office anymore. I'm outside.
Where they do pancake swap and they do, you know.
No. Hold on a second. I said in my promo point, the point of our protocol is that you only need a banking license or a brokerage license. You need a banking license to move real currencies, not necessarily cryptos right now. You need a brokerage license to issue, finance, or trade securities. So that's not going away. But who is going to be the banks and brokers? You've got the Googles, you've got the Facebooks, you've got the Verizons, you've got the Walmarts. Those guys, if we create a decentralized market, they can enter without the legacy systems, without legacy problems, and they can do it all on a regulated base on near real time. That's the real potential.
Well, like Libra suggested, that they could offer a payment service that would be more convenient than what was currently in existence. And
but that's a centralized. That's a centralized. That had flaws in it. I mean, if it's issued by somebody, it's centralized. So therefore, it's going to
be forcing people to use these services. Then people will only reach for them if they're the best in that user's opinion. So, like, what's the fear?
No, I get it. I think the big thing and the challenge we've all got is ease of adoption. You know, because if it's not easy, no one's going to show up.
We don't want frauds. We don't want hacks. We don't want people to have a bad experience investing or doing, you know, fractional banking. And like you know, I'm maybe different than the rest of the crypto community in that I like the fractional banking system. I think that
I can support it. I can support fractional reserve accounting. That's what we had to be. Otherwise, you collapse the monetary system. So
all right, gentlemen.
As much as I disagree with the monetary system, I can't actually, you know, elect it out or vote it out. So it's like,
and I'm back in here as moderator now. We've got about 10 minutes before we go into our breakout rooms. This has been a lively and fun discussion, as I knew it would be. I'm going to ask each of you for a short answer to a question that could be long, as most of them are, and then we've got a number of questions from the audience I'd like to pose to you guys as a group. And so for this question, I'm going to ask you, I'm going to ask each of you individually to espouse on it for just a moment or so, if you would. And it's big picture, and it's looking to the future, and it's really, what is, if not the next, what is a near future aspect of traditional finance that DeFi is going to have a crack at? What's one of the next big pieces of traditional finance? Paul, you come from prime brokerage services, commercial banking. What's DeFi going to go after next? We got some lending and credit going on, maybe not credit, but lending going on. What's next?
We do have credit, delegated credit now.
The first thing this is very ironic, but the first industry that's going to lose to DeFi are crypto exchanges. Crypto exchanges are sunk. There's no reason to use them anymore. You can get all your liquidity and all your trading done on chain, on a DEX, no counterparty risk, no AML, no KYC, and this is clearly a regulatory problem, but crypto exchanges are doomed by their own invention.
Interesting.
I always make the point that if there was ever a business that should be the champion of a blockchain ledger, it should be a crypto exchange. But apart from interacting with the various blockchains, they run a normal ledger in their back offices. Why? Because the blockchain couldn't handle what they do. So I agree with you, John. I think exchanges as a mechanism may work, but I think from an industry perspective, I think and I'm not in agreement with the designs currently with the central bank digital currencies, but I think if the payments world, especially institutional payments and the financing of those payments, that's a sort of low-hanging fruit that will get everybody used to the concepts of what is truly a decentralized settlement and financing mechanism. And then that'll open the door to the other instruments.
Blake, you got a thought as to what's going to be one of the next kind of markets of traditional finance that really DeFi goes after?
The exchanges, obviously, I think that's a great answer. Merchant banking, I think, is relatively low-hanging fruit. Paul probably has a comment about that from the regulatory perspective, but I would too. And I think some of these weirder, more archaic, more kind of shady, greasy insurance, let's just say it, insurance and also derivatives. I think that there's a lot of accounting and lack thereof that should have happened or should happen. Whether it's just premia and risk, or whether it's the actual size of securitization or the velocity of collateral, which is in a collateral chain today impossible to quantify. When you're talking about valuing some of these longer derivatives. I think being able to have a programmatic basis for these things is something that reduces the systemic risk of some of these instruments. Is it the next thing that happens? Probably not. I think the next thing is probably just some Robinhood looking app that it's just a savings account and is functioning using a stable coin.
A global savings account. Blake, your Vertalo, your firm, is disintermediating CPA work for people by tokenizing cap tables. You're doing it for Sarson funds. We've signed up. We haven't done it yet, but we're a client of Vertalo.
Yeah, we're still working on bringing this into DeFi, but on-chain shareholder registry, ability to tokenize whatever asset is being represented digitally on those cap tables, building and maintaining the API connections between those cap tables on-chain and these different exchanges, ATSs, custodians, broker-dealers. Basically everybody that represents the counterparties and intermediaries within the private asset market, being able to take any asset on a cap table and immediately access the services of these service providers or intermediaries. That's step one. The next step that we're looking at is taking these tokenized assets and getting them into a DeFi protocol such that you have credit availability and programmatic borrowing opportunities.
Bingo. It's all about DeFi. That is all we're going to be doing for the next 10 years, is moving collateral into DeFi, putting collateral on chain. It's easy to put assets on chain. They're natively digital, but it's a lot harder to put, shares in a company on chain, someone's car. You have to have like the connectivity to the real world physical collateral, and moving all of that stuff on chain is how DeFi grows.
In a related, I was speaking to someone recently who's in the blockchain world, recently purchased a house and had to pay $500 for title insurance, which is part of the process. And it struck me that how can searching for the title to someone's ownership of a home, how can that be worth $500? Shouldn't that just be a database or a series of databases like a blockchain? So I agree. Hey guys, we got 5 minutes.
That is a. You show me a title insurance company that's paid out, I'll give you $5.
All right.
Hold on a second. I've got one. Hold on a second.
It's going to be 1 or 2 word answers for this first question.
Okay.
Currently, most all the DeFi products are running on Ethereum. What is the next blockchain upon which there will be serious DeFi projects built? If not Ethereum, then what?
Binance Smart Chain.
Binance Smart Chains is one. Okay. Blake, you got a thought?
Ethereum 2.0.
Interesting. Okay.
No, I'd say Avalanche and Naval Labs has a great shot.
Okay. Paul, any thoughts on that, or not your wheelhouse?
Don't know.
Algorand is entering DeFi. They've got an Algorand US dollar coin. They're doing it through StakerDAO, along with Tezos, who's entering DeFi. Waves is entering DeFi. The Neutrino protocol. Bancor is entering DeFi, and they also have Bancor stable value token, and they are bringing EOS into DeFi as well.
You will, and if you had to put your money on one?
Binance Smart Chain.
Binance Smart Chain. Good to hear.
Then Bancor.
Next question from the community, guys. I'd like to talk a little bit about, if you could, your thoughts on the Department of Justice taking action against BitMEX. It was both CFTC and Department of Justice taking action against BitMEX. This is not necessarily a DeFi question, but so what happens? Is this going to hurt? Is this going to hurt bringing U.S. professionals into these fields? Are people going to only do it here in the U.S. if they're regulated? Are real professionals going to move overseas and ignore the U.S. market and just build for Southeast Asia or Latin America or Africa? What are your thoughts?
No, it's just going to become much more expensive to spin up and operate an exchange. It's going to become more prohibitive to use an exchange. I mean, it was like 2 years ago where DOJ sanctioned those Iranian Bitcoin addresses. That means they have the technology to reasonably enforce those sanctions. I mean, the DOJ action and CFTC action against BitMEX was for 3 real reasons. One, just lack of KYC, AML, and the proper identification protocols. 2, running a commodities exchange without the CFTC license to do so. And then 3, the potential money laundering and terrorism financing and that sort of darker stuff that happened on the platform, but not be directly attributable to the people that ran the platform. So, I mean, it's all stuff that it's probably 2-3 years too late. I mean, this is a train that left the station a long time ago. This isn't stuff that Arthur didn't get arrested or at large, and this was announced, and everybody was surprised. I mean, this is something that we knew it was going to happen. 100x leverage. We didn't want it to happen. It's been fun, but
they were actively marketing to U.S. customers for sure without a license, so we knew it was coming. Okay,
you got to grow up. I mean, that's the problem with these things.
I'm not promoting either side, but it's unfortunately where the crypto world has been given some leeway in terms of regulation, but as they expand these tools and solutions, they're going to have to be careful about crossing the line. And most people don't realize that coin offerings all had to be offshore. Ethereum is a Swiss foundation. You're dealing with things that look like they're online and under U.S. regulations to protect you or just to restrict you or whatever. But the reality of it is people can be a little bit cavalier in terms of what they think they're doing and how they do it. And again, I come back to the idea of most of us most of the individuals in the world are not going to do these things themselves. They're going to go through an intermediary. And once that intermediary has fiduciary responsibility, like the DOL regulations and everything else, how can you go back in front of a judge and say, I lost my client's money, but I was told that the network that it ran on was secure because of game theory, and I hope I can win this litigation. So the point of the matter is that you've got to be careful where these regulations begin and end. And I love the innovation, love the creativity, but we've all got to work within the world. I hope to dismantle or obviate. If we get near real-time settlement, day traders today are limited to 4-to-1 leverage, 4-to-1 margin, right? That means they can borrow $4 against the one, right? And what it is because with T+2, as soon as they burn through their turnover, they have to stop. With a near real-time settlement, their leverage is 4-to-1, but their turnover can be infinite. So one of the benefits of near real-time settlement just gets rid of that margin regulation. So a lot of this technology and a lot of these clever innovations around decentralization, you're not going to have to take away the regulations. They're just going to make them obsolete. And that's the real opportunity, and still be secure and still be safe. And believe me, if we can give real-time data back to the regulators, on an aggregate basis, and it's uniform across the network, they're going to love it, because at the moment they have to go to every institution and ask them for the same report, and then they supposedly aggregate it and review it and then feed it back. And we've all, the big thing is KYC and AML, but the big report out of the FinCEN was all these big banks are ignoring it for their big clients. So
they ignore it anyways. I would agree. Yeah. So, gents, I'm going to have to stop us here. Thank you so very much for your time on this panel. Like I said, it did turn into a lively discussion, which I appreciate. And for all of those who are listening, I appreciate that you've joined us here this evening. And each of our panelists is going to be in a different one of the breakout rooms. And so Boston Blockchain Association thanks you for joining us here. And now Mike Wise, who's chair of the board of the Boston Blockchain Association, is going to give you a little heads up as to what's coming up next and how to follow up with some of these breakout rooms that are happening. Gentlemen, I'll be seeing you in the breakout rooms.
Thank you, guys, and thanks, Blake, John. This is great.
Thank you, Paul. Thank you, John. Thank you, Mike. Thank you, Stephen. Appreciate it. This is fun.
Hey, thank you guys for coming. We really appreciate it. I just wanted to give another shout out to our corporate members, Algorand, Bloomy, Pure Stake, Boston Fed, Media Shower, Consensus Fabric, Northern Bank, and Clove. I posted a link to the chat on our next event, which is in 2 weeks from tonight. It's a really awesome event on ticketing and disruption in the ticketing environment. A fantastic event. The breakout rooms are, room number 1 is going to have John Sarson, and room number 2 is going to have Blake Richmond, and room number 3 is going to have Paul Dowding. So again, the links are in the chat. They're Jitsi links. Join. If you would just moderate yourself and turn off your microphone if you're not speaking, that would be awesome. And we really appreciate everybody coming. Thank you so much. And on behalf of the Boston Blockchain Association, that concludes our panel on decentralized finance. Thanks for coming.
See you in the breakout rooms.
Thank you.